Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With U.S. retail sales numbers out stronger than expected, it's clear that even in light of the tariff overhang, consumers are still spending into the economy. Today, we're going to learn more about where growth stocks may be hiding in plain view across U.S. equity markets. Companies that often grow with long-term structural themes, as well as those that are currently pumping out large amounts of free cash flow, fit this strategy. Aspects of the AI trade fold nicely into the growth outlook, but which areas have the most untapped potential at this stage? Joining us to speak about growth opportunities across this market are Fidelity U.S. Growth Opportunities Class Portfolio Managers, Kyle Weaver and Becky Baker. Great to see you both. Welcome to both of you. How are you?
Great. Thanks so much for having us.
We're delighted to have you here. Kyle, I might ask you to start us out here. We spoke with you several months back at this point, and I'm curious sort of how different everything has been in light of market volatility, and then we're going to dig into the actual strategy itself. But it's something we're asking people a lot right now. This has been a rocky road for markets. How's it been for the fund?
In the last 6 months, Pamela, it's definitely been a volatile period of time with a lot of ups and then downs and then ups more recently. Writ broadly, the kind of the Liberation Day tariff madness was, a big source of volatility in the middle of the period, and it was actually around this time, just 3 months ago, that was unfolding, and companies were trying to give guidance in an environment of extreme uncertainty. I think since then that we've seen both some kind of just return to maybe reason or normality in some areas, and also the strength of some of the secular themes just continue to power through what's been a tumultuous environment. And Becky and I have used that to try to double down on some of the positions that we feel very strongly about on a secular view, and then and while still keeping the fund kind of insulated from as many corner cases as we can think of, right, when it comes to like the macro uncertainty.
Yeah, no, that's fantastic. And that's sort of what we wanted to hear about. Becky, I wonder, is there anything to add there? Has the fund done what it's meant to do through moments of, you've been able to?
Yeah, I think we're pleased with how the fund, I think we are pleased with how the fund has performed year to date. I think we're up absolute and we're up relative to the benchmark. And I think we're happy that during this period of uncertainty, we were able to find, secular growth stories that we think are underappreciated with a long-term view and take advantage of the volatility while, being very conscious of how dynamic the environment was and not taking unnecessary risks. So I think we are happy with how the beginning of the year has gone.
Kyle, let's jump into the AI trade and the many prongs, actually, that there are to this. We've spoken to you about this before. I wonder, just as a broad comment, what's different about your investing in AI today than, say, even at the beginning of the year? What's sort of taken off from the way that you're looking at things?
That is a big question, Pamela. But I will say, many of our largest bets are quite similar, which shouldn't be surprising to our shareholders since we try to, invest with a long-term view. Always keeping in mind that, we want to change our mind as the facts change. But I think we've actually seen a lot of our both big public company bets and some of our smaller private investments really make the progress and that we've been expecting them to make over the last several months. There are some emerging winners in the space, and some companies that seem small or just conceptual a couple of years ago now have real revenue and are, represent real forces in the industry. Some of those are private holdings, and some of those are also legacy companies like IBM and Oracle that have been around for decades, but that are seeming to capitalize on sort of new life being breathed into them from the developments in AI. It's a big topic, and we can take it where you
Very
want it to
well.
go. But I don't
Okay.
know, Becky,
All
maybe
right.
you have some other thoughts on the.
Yeah, well, I wanted to just pick up on a couple of things you said there. I'll ask Becky one of these questions. This was a theme that you mentioned. This is the headlines that we keep seeing about trying to acquire talent, sometimes ideas. There's been an awful lot made about this. Becky, how are you looking at it, following the headlines? You're probably ahead of all of the headlines, but I think it's sort of this acqui-hiring that is the question mark is whether it's, is it worth it?
Yeah, acqui-hiring might have been a word that was new to my vocabulary as of a couple of years ago, but it means, acquiring a company or acquiring talent from a company because you're focused on that talent as opposed to some other assets from the company. And so we've seen that from a lot of the big tech companies that they're going to startups that are having various levels of success and acquiring some of the assets that they view as valuable from those companies, but also taking founders on board because they think the talent in AI is important enough that if they assemble the right team of players, that it can make a difference in their AI efforts. So we've seen acqui-hire type acquisitions from Meta and Google just in the past couple of weeks, and from Microsoft and others before that. And I guess from where we sit, this strategy does make sense. If you had asked me to predict who were going to be the winners in AI a couple years ago, I might have said the big tech companies have enormous advantages because they've got capital, they've got distribution, and they have, a huge employee base, some of which probably has important talent or important expertise in AI that can help them. And while those companies have done really well, I think it's been an upside surprise to see the progress that some of the startups have made, whether that's OpenAI or Anthropic. These names are in the headlines every day because they've grown into really meaningful companies in this movement. And so I think the fact that those companies have been able to make such strong progress, despite, not necessarily having the advantages that their competitors have, speaks to the importance of talent in this market. And so I guess the question from here is it easy to proactively identify who are the key people that are worth acquiring a company for that talent? Or, there was been some headlines about $100 million signing bonus for key employees. Are those types of numbers worth it because are you getting the right people? And obviously the companies that are making these decisions think they are, but that's something we're certainly going to be watching.
Kyle, do you want to pick up on that? There's been some, take that anywhere you want, because there are so many pieces in that. It's obviously a very exciting time for you watching this.
Yeah, I mean, just I think it helps to put it in context of the size of the investments that are being made overall, such that, $100 million signing bonus for a unique talent in the space. It's easier to understand how that might make sense. I'm not saying that it does or doesn't, but how it might make sense if the big three hyperscalers are spending hundreds of billions of dollars in 1 year alone on the GPUs to run these models. You want the best GPU driver in the world to be running that, to be in charge of such a large multi-$100 billion set of investments. So I think it kind of makes sense on that front. And then I would just add, and the way, I think the dollars being spent on talent are, synonymous with, they dovetail with big investments being made all up and down kind of the value chain for these companies as they build out their models. And, for example, even when you look at the energy requirements and the power requirements that are needed to provide electricity for these large models and the inference capabilities, it's why you're seeing also some unique, it's kind of like asking, hey, is it worth spending $3 billion to reopen 3 Mile Island? And, companies are also coming to the conclusion that, yes, like we should reopen, retired nuclear facilities in order to get electricity. So like there is a real race here. And these are the sort of the best funded, best capitalized companies in the world that are involved in it.
Can I ask you, Kyle, just to follow up on that? Are we still talking about, are those still picks and shovels to the AI story? It feels like that was what we were talking about a year ago, and the investments were there. it seems like a new stage. It's not just picks and shovels. It's more than that, but it's still an energy story, isn't it?
Yeah, I do think the energy story, which we do have represented in the fund in a few ways, mostly through the independent power producers. It's an interesting part because we initially came to it for the some of the regulatory provisions that were favorable to the companies. We became more interested in it because of the AI angle and the additional demand that these large hyperscale data centers were going to bring to the electricity market. But I think, as we've come to know those names better, the thesis has become almost even more structural in the sense that, the U.S. hasn't really built a lot of electricity capacity in decades, and there's been a multi-decade shift of becoming more energy efficient, and it's a relatively new phenomenon to be in a supply-constrained market, which puts these companies that do have electricity that they're able to sell at prices that are needed to justify further investment in a really good position. So
that's really interesting.
I sometimes joke that this is one of the few examples of positive thesis drift, where you kind of come to an idea for one reason, and then you just sort of find more and more reasons to believe in it as things go on. But AI is certainly a part of the story, but it's all in the context of a very kind of structural supply demand story that I think will take years, if not longer, to sort of play out.
And you're right in the middle of it. It's so interesting, Becky. Not long ago, we've been hearing lots about all of the tariff discussions, the trade negotiations that have gone on, that are still going on. One of the big ones, obviously, between the U.S. and China. It seemed like commentators came to part of a conclusion that it wasn't actually so easy to just decouple from China, because there's an awful lot going on in China that needs to actually work and perhaps work together with the U.S. One of the biggest companies in the world sort of went to bat for that thesis. I think it's something that you would follow very closely. What do you think of sort of AI between China and the U.S., the opportunities therein? Do you like seeing companies having exposure to the Chinese market, for instance?
Yeah, I mean, so I think I'll rewind a bit and just remind the listeners that U.S. companies had been selling AI infrastructure into China for a couple of years, and then the prior administration had decided that for strategic reasons, we should limit our sales of the most advanced AI systems to China so that we could have a national security advantage and kind of keep the U.S. out in front. And as a result of those restrictions, NVIDIA created a special purpose system for Chinese buyers called the H20, and they were allowed to sell this into China. It's a few generations behind what they're selling to U.S. and other global customers, but it is still the best system out there. If you're subject to these restrictions, you'd still rather have these NVIDIA systems than anything else. And so when the Trump administration came in, there was originally some optimism that they could get even more relaxed standards, and NVIDIA might be able to sell something closer to what they're selling in the U.S. And instead, we saw it go the other way. And they were restricted from selling even the H20s that are a few generations behind into China. And so last quarter, they said they expected this ban to cost them about $8 billion in revenue this quarter that they're about to report. And so they were very disappointed in that decision. And I think the strong case that the company made about why these rules were actually not in the interest of the U.S. is that 40% of the world's AI researchers are in China.
40%. 40. Okay.
So as much as we might want to try to cut China off in order to keep the U.S. ahead, that it was going to be very difficult to do that successfully because of the talent that's concentrated there, and that it was actually in America's interest to have the best Chinese AI models built on American infrastructure. And I think we saw a very strong argument for this when the success of the DeepSeek model became news. And so what we saw with DeepSeek was they were able to train their model more cost effectively than U.S. companies had been able to. And there were some other interesting realizations that they had when they were building their most recent generation of AI models. And so the positive thing for U.S. companies that developed from this was they were able to read the DeepSeek paper and take the learnings that DeepSeek released and apply them to their own models. So we were talking to a lot of the private U.S. AI startups about how excited they were about what DeepSeek had discovered. And I think part of the reason why this worked so well is because everyone's running on the same infrastructure. And so I think we're happy as NVIDIA shareholders to see this revenue opportunity come back to them. But I think we're also believers in this idea that trying to cut China off, it may hurt them in the short term, but it's unpredictable because you don't know what U.S. companies are going to learn from Chinese innovation. And then in the long term, China is not going to give up on AI. And so if they can't buy NVIDIA chips, they're going to buy from somewhere else. And if that's a local supplier, it may be worse for the U.S. So I think we were pleased to see these headlines, as I'm sure NVIDIA was too. And I think we think they make a lot of sense for the country.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Yeah. Anything to add there, Kyle? I was going to ask you another piece, but that's fascinating.
No, Becky, that was perfect. I just think like that point about really, I think what the argument was that NVIDIA needed to make was that it is in America's best interests to sell to the Chinese and allow them to use to build on American infrastructure. It's the difference between sort of short-term strategy and long-term strategy, and I do think they were correct to argue that. I'm glad that they had success.
Speaking of long-term strategy, let's just go back to the style of how you invest. Kyle, we've been through this before, but it's always good to remind people sort of types of buckets, how you go after particular stories that have growth attributes.
Yeah. So just to remind our listeners, Becky and I, we generally invest on a 3 to 7 year time frame, looking for companies that can double or triple over that period of time, and that are going to be very cheap as they get to those out years, which we think is just is what a growth company is supposed to be. It's a company that proves its cheapness over time. Can get there in different ways, and we always try to have some ideas in different baskets. The core of the fund and the index that we're up against and trying to beat every day is full of strong long-term growers, which are your, the big index components from Visa and MasterCard to NVIDIA and Microsoft. And we try to find the best combinations of growth and value and durability in that basket. One to either side of that are names that may not be in the index they may not be large in the index yet, but we hope will be one day. Some are the breakthrough growth companies, we call them, and that's everything from small cap biotech names that where we're waiting for the science to prove the business model, to fast growing companies in either the tech space or consumer space that we think can be much bigger over time. And just as one example, like Tesla, which is not which is an underweight in the fund now, but has at times been one of our larger bets. But Tesla started out as a breakthrough growth company when it was an unprofitable car company that didn't have any mainstream models, and since then it's, become $1 trillion market cap stock with its whole new set of controversies around it. But that's one example of the breakthrough growth bucket kind of graduating. Netflix would be another example. And then, on the other side of the fund, we call them resilient growth. It's kind of code for names that a value fund manager might own, but we like the growth story. Oftentimes the growth story there is underpinned at the level of free cash flow per share or earnings per share growth rather than fast top line growth. And we have a number of names in the fund that fit the bill there, and from Flextronics to T-Mobile. These are long time holdings that are starting off at a very reasonable level of valuation, and we think just get much cheaper as their business models compound and as they allocate capital correctly. So the common theme is that we think all these names should be cheap on a multi-year basis. And the kind of the key reason that we try to have some names in all these different buckets is because the second one of the other rules we try to follow is to keep the fund positioned to take advantage of volatility. April was that Liberation Day was another instructive case lesson how important it is to do that. You don't want to have everything go up or down the same amount at the same time, or you can't really do that. And so we try to have, a variety of ideas, even looking across sectors and across geographies and across themes that also belong to these different buckets.
Okay.
And have sort of different growth profiles there. And Becky, I don't know what you would add to that.
Yeah.
I think that was perfect.
Yeah, it's so good to come back to that and to be reminded and actually, hear some of the names that you put in there. I feel like this is a good moment to move to the discussion of connected TV. We are in the midst of earnings, and the earnings are coming out all over the place, and there happens to be something that fits this bill coming out pretty soon. But the overall discussion of connected TV, Becky, it's been going for a while. I just wonder if there's sort of new tipping points within this story.
Yeah, I think we've been excited about companies that operate in this connected TV space for a couple of years now. So as you've mentioned, it's about to be tech earnings. Netflix sort of kicks us off tonight after TSM this morning. But what we're excited to see, I think, in the next couple of quarters from these companies is the progress that they can make on monetizing the enormous user bases that they have with advertising. So in the case of Netflix, it's only been a couple of years since they started even offering the consumer the option to sign up. And instead of paying a higher monthly price, they can pay a lower price and see some ads. And this has been a really popular option for consumers. I think they said last quarter that 50% of their signups are coming in the ad tier. So people really like this. And I think it also helps them, if there's a consumer who is feeling a little more squeezed in terms of their budget, it prevents that consumer from churning, because as they're, maybe logging on to leave Netflix for a period of time, they see this option to stay, but watch a couple of ads and have to pay less. And so I think it's helped Netflix in a lot of ways. And we'd really like to see more progress in their advertising efforts, given how popular this plan has been with consumers. But there are other names in this space that we're excited about. Roku's been a long time holding that announced an exciting partnership with Amazon this quarter. And it may take some time to play out, but I think these tie-ups make a lot of sense in a market where there's just an enormous opportunity as they focus more on advertising.
Kyle, take some of that away. As you mentioned, Roku's been there for a long time doing some of this, but these tie-ups, it seems like sports is one of the main things that is coming faster and faster to a more connected TV model. Is it fast enough, or are those old long-term media legacy deals just still hanging on?
I think it's coming. I mean, one of the luxuries of looking at growth over a 3 to 7 year time frame is, I think we don't spend as much time trying to pinpoint exactly where the tipping point is, but we're pretty sure the tipping point is coming, or we might be in it already. I think the questions when we get to invest on a it's a matter of when, not if kind of basis, we tend to like that. We think that we've found that with some of the connected TV names that we own in the fund and that we've owned for a while. And I mean, Roku is a great example. We've owned it for a while. The stock has actually been one of the big laggards relative to others in our fund over a 2 and 3 year basis. But over that period of time, and part of the reason it remains such a strong position is they've just continued to grow their installed base, continued to take share as an operating system, continue to build advertiser relationships, and they've just begun to open up their platform to DSPs, that's demand supply platforms. Sorry. And that will monetize the data that Roku has on the viewers and what they're watching, which is something that all advertisers and the DSPs that they use to advertise are very excited to pay for. So we think that it's happening, and that sports is one of the real accelerators to just getting people to kind come over and turn on the football game on their connected TV instead of trying to find it on a linear channel.
I'll just pivot a bit to other things that would be in one of the other buckets that you mentioned there, Kyle. But Becky, just putting to you actually the story of rates, which has its own headlines going on right now, certainly. But just the idea of rate-sensitive industries, ultimately, where you do or don't find a kind of a cyclical story. I think you'd mentioned housing last time we spoke, and rates had come down at that point. Maybe just a bit of an update on some of those other industries that you're involved in and that you're finding opportunities in.
Yeah, I think we are excited about the prospects for housing, but I think similar to the way Kyle described the situation in connected TV, this is a matter of at some point we think the housing cycle is going to turn and it's going to be a tailwind to many of the stocks that we own, but we're not sure exactly when. In the U.S., we've had a lot of headwinds to housing. We've had issues around affordability because of the inflation that came after COVID. We've had rates rising, and now, even though they've sort of stabilized, it's been a headwind because so many consumers have very low mortgages on their homes. And so as a result of those dynamics, existing home turnover is at least 25% below the long-term average. We have a significant shortage of new housing in the U.S. that we think does need to be rectified over time. And so in the fund we own, building product companies that we think will benefit from this new build dynamic coming back. We own some internet platforms that help consumers find a new home. And we think when existing housing turnover improves, that's going to be a positive story. And, unfortunately, this has been a space that we've been hoping would turn for the past year. It has not started to turn yet. Q2 looks like it's shaping up a lot like Q1 did in terms of down slightly year over year for pretty much everything in the housing space. But it's kind of nice, I think, in a period where we have a lot of stocks working in AI, a lot of stocks that are exposed to tech broadly have been great contributors to the fund. I think we're actually happy that we have some spaces that feel like they're really getting no love in the market because hopefully that means there's some good things ahead.
Yes, it's sort of the takeoff, the runway for some of that. Kyle, just wanted to ask you actually about healthcare. That does seem to be of the policy pieces that have been issued through the One Big Beautiful Bill and so on. It's been crushing for some investors in healthcare. I know you're in different areas. You mentioned biotech earlier, so that isn't really the same thing. Do you still like parts of healthcare? Can you bring us up to date on that?
Absolutely, yeah. I think the managed care space is a tough one, and I don't think you'll find us expressing much conviction one way or another there. But there are the science in the U.S. is still outstanding, and there are a lot of breakthrough areas to invest in. I think in biotech in particular, I've mentioned that oftentimes we'll place very small bets in companies that are years away from commercializing a drug. What I think is interesting now as we were reviewing the fund just recently is some of the names that we've owned for a couple of years based on promising technology, they are getting close to where the commercialization is going to happen. And a number of those, now we look and we think they're only 2 or 3 years away from having a very profitable drug that will make the stock look very cheap at today's prices as it has commercial success. We also own some medical device companies that have a proven product out there that saves lives, is easier to operate, that doctors love, and are taking share in large areas of the healthcare space through better technology.
Fascinating.
And so healthcare is a very idiosyncratic space, and it's a perfect example of how these stocks often will move together on a day-to-day basis, even though over the long term, it'll be the science. Each one is a completely idiosyncratic story. So I think we like a lot of the bets that we have there, and although you won't find many of them in sort of our top 5 or top 10 because we're pretty well diversified.
It's really interesting. It goes back to what you were talking about, style, and sort of the 3 to 5 or even to 7 year outlook that you have. Becky, I might just ask you to share some final thoughts, maybe slightly reflective on what's gone on in the markets and ultimately where this fund belongs for investors. We don't have a whole lot of time, but if you could just a final thought on what you want to leave with investors today.
Sure. I think we're optimistic about the way that we have the fund positioned, and we're working really hard to find great ideas that look cheap looking out 3 to 7 years, just the way Kyle described earlier. And I think the nice thing about this period has been, despite a lot of volatility created by interest rates and tariffs and dips to consumer confidence and sort of a laundry list of macro-oriented headwinds for companies, what we're hearing from the management teams, what we're seeing in the results in recent months has been really encouraging. And that may be because they had navigated this really volatile period during COVID and then in the wake of that. And so they're sort of ready for a lot of things that might come at them. They're ready to navigate a lot of macro choppiness. And so I think we're pleased with what we've been seeing and hearing, and we're optimistic about where we're headed.
It has been so exciting to hear about what you're invested in, because it is so exciting what you're invested in. Kyle Weaver and Becky Baker, thank you for joining us here today.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.